Iris Energy began in 2018 with hydro-powered Bitcoin data centers in British Columbia. Today, it holds 2.91 gigawatts of grid rights and a $9.7 billion in Microsoft AI contract. Founded by brothers Daniel and Will Roberts, Iris Energy focused on renewable-powered Bitcoin mining. The company listed on Nasdaq as IREN in November 2021. The core operating footprint includes 3 hydro-powered data centers in British Columbia totaling about 160 megawatts. These sites form the backbone of Iris Energy's early Bitcoin-focused business model. At Canal Flats, roughly 30 megawatts of hydroelectric capacity supports around 0.8 each per seconds of mining. Mackenzie adds about 80 megawatt across 4 20 megawatts halls, supporting approximately 2.5 to 2.6 per second. Economically, FY25 revenue was dominated by Bitcoin mining at about $485 million. AI cloud and high-performance computing services contributed around $16 million. Iris Energy reported all-in cash costs of roughly $36,000 to $41,000 per Bitcoin in FY25. It often realized prices above $60,000 per Bitcoin during the same period. Here's the problem. Total operating data center capacity jumped from about 345 megawatts to more than 810 megawatts within FY25. Over the same period, contracted grid-connected power rights expanded from 2.16 gigawatts to 2.31 gigawatts and then 2.91 gigawatts. That scale requires clear capital allocation between Bitcoin mining and AI infrastructure. Between March and June 2025, Iris Energy said it would pause mining expansion around 50 to 52 EH/s. Incremental capital would instead be directed toward AI infrastructure build-out. By 30th of June 2025, the company reported 50 EH/s of installed capacity. Average operating hash rate in mid-2025 was around 45 EH per second. AI cloud revenue was about $3.1 million in FY24 and roughly $16 million in FY25. In Q4 FY25 alone, AI cloud revenue reached around $7 million. Economically, AI cloud hardware margins ran around 95 to 98% in FY25. Bitcoin mining hardware margins were about 60 to 70% under favorable Bitcoin price conditions. Here's their position. At Childress in West Texas, about 350 megawatts was operating by December 2024. Another 400 megawatts was under construction toward a planned 750 megawatts total. Childress is connected via a 345 kV line into ERCOT and moved to spot pricing. Iris Energy reported an effective power cost of roughly 3.0 to 3.2 US cents per kilowatt hour. The Horizon 1 liquid-cooled AI data center at Childress is designed for 75 megawatts gross capacity. It targets 50 megawatts IT load up to 200 kilowatt per rack with energization in Q4 2025. Beyond Childress, the planned Sweetwater hub in West Texas totals 2 gigawatts of capacity. Sweetwater 1 targets 1.4 gigawatts by April 2026, with 600 megawatts at Sweetwater 2 in late 2027. As of March 2025, Iris Energy reported 2.75 gigawatts of contracted power in West Texas. These contracts span its Childress and Sweetwater projects. Central to this strategy is a 5-year Microsoft contract worth about $9.7 billion. It equates to approximately $1.94 billion in annual recurring revenue, with a 20% prepayment and expected project EBITDA margins around 85%. The Microsoft agreement relies on NVIDIA GB300 GPUs at the Childress campus. Capacity is structured largely as long-term, committed infrastructure as a service. Iris Energy describes its broader AI and HPC model as infrastructure as a service with long-term, take-or-pay or committed capacity contracts. It owns the power and data center stack and often finances GPUs via leases or customer prepayments. Looking ahead, FY25 total revenue reached approximately $501 million, up 168% year-on-year. That shift reflects both expanded mining operations and the emerging AI cloud contribution. FY25 net income was roughly $86.9 million versus a net loss previously. Profitability provides internal capital to support AI and data center expansion. Iris Energy targets AI cloud annual recurring revenue of $200 to $250 million by December 2025. Guidance suggests ARR could exceed $500 million by Q1 2026 and reach about $3.4 billion run rate by end 2026 if roughly 140,000 GPUs are deployed and utilized. Strategically, the company has said it will cap Bitcoin mining expansion around 50 each per SES. It plans to prioritize redeploying Bitcoin-generated cash flows into AI data centers and GPU capacity. Management is targeting an all-in cash cost of about $28,000 per Bitcoin. That goal implies a reduction from the FY25 range of roughly $36,000 to $41,000 per Bitcoin as fleet efficiency improves.